All right, good afternoon, everyone, and welcome back to another Iowa SourceLink and Iowa Department of Revenue tax webinar. We're happy to have you here with us. As everyone is still getting loaded in this afternoon, I'll do some quick introductions and housekeeping things. Thank you again for being with us. My name is Patrick Linsman. I'm the Associate Director of the John Papajohn Entrepreneur Center at the University of Northern Iowa. I help manage the Iowa SourceLink platform with the Iowa Economic Development Authority, where we bring resources to small business owners at all stages of growth all across Iowa. One of those particular things that we've been doing for the past decade now is working with the Department of Revenue to bring relevant tax information to you through these live webinars or archived recording if you're watching us at some point in the future. Happy to have Tim and Terry here with us today to talk us through sales and use tax for construction contractors. So before we get started, my colleague Sophie here in the background, she just posted in the chat the link to the slides. You can go out to the chat, click that link, and download the PDF version of those slides and follow along with today's presentation, whether to take notes or look ahead and see what's coming up next if you're curious. Second, this is recorded, so you'll be able to watch this again at a later date. If for some reason you have to step out or something isn't working, we will have that recording available. Third, the Q&A box is there for you to ask your questions. One thing that Terry is going to help us with today is hopefully answering some of those in the background through the chat. So if you do ask a question, be sure to keep an eye on your Q&A box, as you may be getting an answer through text rather than through the live presentation format. With those, potentially the answer might be coming up in the next slide or two. So if we don't get to your question right away or yet in this session, we will find a way to make sure you get those answers. And that may even include having you have to reach out directly to the department. So with that, I think everybody's loaded up. That's my 2-minute spiel. So for those of you who just joined us, quick recap, it's recorded. We will post a link to the slides in the chat. You can get them there. And please post any questions you've got in the Q&A box, and we will get to them as time allows. So to the topic today, we've got, again, sales and use tax for construction contractors. Doing the presenting for us is Tim Riley. He's the Sales and Excise Tax Policy Director at the Department of Revenue, and here to help him out is Terry O'Neill, Taxpayer Service Specialist. So Tim, Terry, welcome, and Tim, take it away.
Thanks, Patrick. Thanks everybody for joining. I'm Tim Riley, Policy Director of Sales and Excise Taxes. Happy to be with you today to go through this presentation. I think it's been a good three years or so since anybody from the department presented this particular presentation, so happy to get it back up and running. Some of it may seem familiar as if you've attended a presentation like this in the past from the department, but I do have some additional information new from this year, not specific to the taxes themselves, but how to get permits and file returns. That does impact every taxpayer, and particularly, I think, important information for construction contractors. So with that said, we can go ahead and get started. And of course, this is the information here is informal, non-binding guidance being offered by the department. Anything that you wish to use to rely on from the department needs to be a written declaratory order that would be signed by the director. So if you do have any questions about any of the information that I'm presenting, you think I make a mistake, please let me know. And if you want specific answers to specific questions or specific fact patterns, a declaratory order is probably your best bet. Just a brief overview for folks who are new to the department or haven't seen this graphic in a while. Our mission, vision, and values. The vision of the department is that Iowa will be a state where it's easy to understand and comply with tax obligations. The goal is to serve all Iowans and collect all taxes that are due, but no more. For those who are familiar with this presentation, I've made a couple of adjustments to the format, mostly trying to emphasize the legal basis for most of the statements. And if you are interested in reading the statutes or the administrative rules, these are all live links. So if and when you access the slides, feel free to click through all these links here, and they'll point you to where you need to be. And so as I've got this slide here, and then as we go through the slides, you'll see a little footnotes at the bottom referencing mostly administrative rules, a couple of code provisions as well. The main statutory provisions that impose tax, sales and use tax on the items that we'll be talking about: building materials, supplies, equipment, found in Code Section 423.2(1), paragraphs B and C, that deal with tangible personal property and use tax as well in another code section. A lot of what we'll be talking about today is from the department's own administrative rules, filling in gaps that the statute doesn't necessarily provide specifics on. And also wanted to note here that there are obviously lots of exemptions that can come into play anytime you're talking about sales tax, whether it's construction or otherwise. But the primary one that will come up a lot today is that tangible personal property will remain taxable, but services not taxable when used in construction with in conjunction with new construction, etc. And then also designated exempt entities, which we'll talk about briefly later on. So. First point I would like to start out with is, what is a construction contract? This term not defined in statute, but it is defined in our rules, as you can see down there at the bottom. Rule 219, Chapter 219, Rule 8. And the rule itself has more words, but boiled down to a simpler form, it's basically just an agreement to provide materials and erect a building or structure. And so there are two parties that are referenced, the first being the contractor, general contractor, subcontractor, builder. It can be any type of legal entity, including an individual, can be a company, corporation, etc. Any type of legally, party A, party B, so basically.
Recorded.
I seem to have lost you there for just a second, Tim. So if you want
to sorry.
No, it's all right. Your router must have updated or something. So if you want to go ahead and
Yep. So the second party, hopefully everybody caught my explanation of the first party to the contract. The second party is simply referred to in the rules as the sponsor. That's the person who's signing the agreement. Are my slides shared still?
Nope, you'll need to reshare the slideshow.
Okay.
Yep, no problem.
I could look at you, Patrick, for the next 45 minutes, but that probably wouldn't be super helpful to everybody.
That's not what they want to watch. Here we go. We've got them. Thanks, Tim.
Yeah, no problem. All right. So that's all highlighted in the rules there in Rule 219.8. So the next thing that is further described in the rules, more so than in the statute, is the types of entities that enter into a construction contract on the contractor side. So we're not talking about the sponsor here, but there are four main entity types, and we'll highlight, certainly we'll get into some detail about each of these as we go through the presentation. The first being a simple contractor, second being a contractor retailer, third being a straight retailer, also known as, sometimes referred to as manufacturer contractor or manufacturer retailer, but essentially just a retailer of TPP primarily, potentially other services as well. And then fourth, a repair company. So a company that does not provide, doesn't build new buildings or structures, but just provides repair services. So contractor, perhaps I think probably the most straightforward of those four that we went through, listed on the last slide, so the contractor is the consumer of the building supplies and materials. That means that when they purchase supplies and materials, the contractor is required to pay sales tax when they make those purchases. When they are using those products for new construction, reconstruction, expansion, alteration, and remodeling, the contractor of course should have paid tax when they made those purchases. Should not be collecting tax from its sponsor, from the ultimate consumer, because the contractor is deemed by law, by the statute, to be the consumer of those products. In situations that are not new construction, reconstruction, expansion, alteration, remodeling, so generally referred to as repairs, again, the contractor has to pay sales tax when they make those purchases. They should be collecting sales tax when they make their sale to the sponsor for both any taxable labor that's provided and for the materials. Assuming that they do that and that they itemized the cost of labor and materials, making then when the contractor files their sales tax return, sales and use tax return, they can take a credit for a tax that they paid on materials when they paid the sales tax when they purchased those materials, because they then also collected the tax. So additional, as you can see down there at the bottom, additional explanation of these things in our administrative rules. I would also note if you have questions about the difference between repair and remodeling, or new construction versus repair, we'll get to that later in the presentation. The second category of construction entity is the contractor retailer. So this group is what you might think of as a big box store that sells building materials to either people like you and individuals, you and me, or they can make sales to contractors themselves directly. They typically have a storefront, make all types of sales. These types of entities are required to have a sales and use tax permit to collect and remit tax when they make sales. And regardless of whatever they're selling, they need to know whether it's taxable, especially if it's a service, and then also on the materials, should be collecting tax when they make those sales, unless they get a valid exemption certificate from the purchaser. So contractor retailers, as you can see here, because when they get their materials from suppliers such as a lumber yard or whatever it might be, they're making those purchases for the purpose of reselling those products most of the time, unless they're using them on their own in their own projects, in their own construction contracts. So they can a contractor retailer can purchase things tax-free if the intent is for it to be sold if they're purchasing it for resale, if the intent is for it to be resold. They should be paying sales or use tax when they're making purchases of supplies and materials and placing those items somewhere other than in inventory for the things to be pulled out and used later. If the contractor retailer realizes that they didn't pay sales tax on something that where tax is due, something that they're not placing in inventory, they have a use tax obligation. The contractor retailer, as I mentioned a minute ago, should be collecting sales tax from its customers, whether it's an individual or a contractor. If they're selling it without installation, that is, if they're performing a taxable service such as a repair or installation, should be charging tax on the whole service and the materials that they're selling. If they're performing a construction contract, though, they do not need to be collecting sales or use tax. And for materials withdrawn from inventory for use in another state, obviously, if they're being used in another state, the tax is not due in Iowa. I'll mention in a couple of slides while pointing out here too. If contractors buying something in Iowa for use in another state, use tax may well apply in that other state. So contractors, especially contractor retailers, need to be cognizant of that, need to be aware of that. The third type of entity that I highlighted a few minutes ago are retailers or manufacturer contractors, whatever term you may be familiar with. Typically, people who just make sales, either to contractors or to consumers, individuals. Again, here should be collecting sales tax when they make those sales, unless an exemption certificate comes into play. And because they're making retail sales, they need a sales or use tax permit. You may, I'll point this out here too. I'll get into, I'll explain this a little bit later. You may notice I'm referring to it as sales or use tax permit. That has changed in the last couple of weeks, if you haven't already noticed that. But I'll explain those differences a little bit later about no longer having a sales tax permit or a use tax permit. Retailers here, if the retailer considers themselves primarily manufacturer, they should be collecting sales tax on the fabrication cost. If they are primarily considering themselves a contractor, tax is based on the cost of the raw materials. Again, for new construction, for retailers, not collecting tax from the sponsor, from the final customer. If they're performing a taxable service, and we'll talk, again later about what the taxable services are that come into play for construction contracting. If they have materials that they're keeping in an inventory to be used in these types of situations, then they can withdraw those things tax-free. And yeah, here again, for construction contracts that a retailer is engaging in out of state, just make sure that the laws of the other state are noted, because there may be an obligation in that other state as well. Lastly, we've got repair companies, typically companies that rarely, if ever, make sales of products themselves or materials, or build new structures. Obviously, that's why we're referring to them as repair companies. Repair companies should itemize, best practice certainly is to itemize materials and labor separately. And no sales tax is due on purchases of building materials and supplies if they're being purchased for resale. If they provide to their supplier a sales tax exemption certificate, and tax is collected from their customer. If they do not itemize, the repair company should not itemize materials and labor when tax is paid on the materials at the time of purchase, or when collecting tax on the total bill. Next, we'll get into what building materials, supplies, and equipment means, and give you some examples. These terms obviously important in figuring out what's taxable and what's not. These terms are not defined by a statute, and so you can see there at the bottom, Rule 219.3 does provide definitions of these terms, and then that rule is also the source of most of the examples that you'll see in the next couple of slides. I won't read all these word for word. Hopefully you can see these, but these are the definitions that the department has had in rule for quite some time for each of these three terms. Hopefully this font's not too small and everybody can read that, but this is a fairly long list of things that may be considered building materials and supplies. Includes fencing, lumber, obviously, lighting fixtures, plaster, paint, steel, stone, windows, just to highlight a few things. If you want to see the full list, it's there in the rule 219.3. Things that are considered building equipment, generally, as explained in the rule, building equipment is typically not incorporated into the product, does not become part of the realty. And so that includes things like lathes, hand tools, generators, compressors, other types of equipment. And also here I'll note building equipment as defined in this rule 219.3 not the same as equipment, which has its own definition and has its own excise tax, which we'll talk about in a minute. These are two separate types of things: building equipment for purposes of sales and use tax, and then equipment for purposes of the excise tax. So a couple of years ago, maybe a while ago now, a decade or so ago, the legislature enacted, or maybe it's more than that, about 15 years ago, I believe. The Iowa legislature enacted a new excise tax for construction equipment, or as the statute just calls it, equipment is the defined term. We generally at the department refer to it as construction equipment excise tax. And so they exempted these particular types of items from sales and use tax. As you can see there at the bottom, code section 423.3 subsection 85 is the exemption. And then those same items, instead of being subject to the 6% state sales tax and potential another percent most locations in Iowa, or local option sales tax for a total of 7%, these types of items, these certain qualifying equipment, are subject to a 5% excise tax. And so there you can see the types of equipment that qualify. The equipment itself has to be directly and primarily used by contractor, subcontractor, builder for new construction. One other item that I'd like to note before we shift gears a little bit more is that a couple of years ago, and I think this was brand new the last time this presentation was given by our former colleague Paul, if anybody attended that one, was so new in 2019 was an exemption for grain bins, and so if I recall, when Paul gave that presentation, we had not yet enacted our administrative rules. But we do have rules now. They're linked there at the bottom in Chapter 226, as opposed to Chapter 219 covers construction. 226 is the agricultural rules, so that's where we put this rule. But the legislature in 2019 enacted a new exemption for grain bins, and it was for bins or materials used to construct a bin. And you can see there the definition of bin. The rule itself gets into pretty minute detail about types of things that are considered to be permanently attached to a bin or not permanently attached to a bin. That is the general rule of thumb. Though if you are if you work with bins, you'll want to, if you haven't seen the rule, you'll want to check out the rule for additional detail and explanation. So, as I mentioned, I've mentioned a couple of times now, certain services are taxable in Iowa. Iowa taxes most, if not all, tangible personal property, unless it's otherwise exempt, but has the opposite approach to services. Services are exempt unless otherwise listed in the statute. And so, in code section 423.2 subsection 6 has a very long list of taxable services. These are listed here I think captures all the services that might impact construction contract, come into play for a construction contract. And so taxable services used in construction contracting is highlighted rule 219.13. It's a long rule, but there's a lot to cover here on this subject, so make sure you take a look at that. And also chapter 26 of our rules, the whole chapter gets into quite a few of these rules, or quite a few of these taxable services, excuse me, because they don't apply just to construction contracting. They can, obviously apply more broadly. So if you provide any of these services, any of your clients provide any of these services, or if you purchase any of these services, want to know whether it should be taxable or not, make sure you take a look at our administrative rules that cover those. So in general, labor is taxable when it's performed to repair something, not taxable when performed on new construction, reconstruction, alteration, expansion, or remodeling, which gets tiresome to say. So I'll just refer to that all as new construction. So you have either new construction or repair. So if it's a repair, it's generally taxable. If it's new construction, not taxable. In the rule in 219.13, there's quite a bit of explanation about how the department determines whether something is used in connection with if something is a taxable service or not, basically used in construction, whether it's repair or remodel or new construction, things like that. So a couple of the factors that come into play listed here, that each of these bullet points, don't need to go through them all. You can hopefully read them all, but a couple of things I know surprise people when they hear it the first time. Replacing items. If the example here is if a furnace is being replaced in a building, in a house, if you're simply swapping out a broken furnace for a new furnace, that's deemed a taxable repair. Even if you're not technically repairing the broken furnace, you're replacing the broken furnace. But if you are replacing a functioning furnace for a better furnace, for a more energy efficient furnace, whatever it may be, that's changing the structure. That's a change to the building itself, providing better, a better quality product, a better furnace for that house, for that building. And so that's reconstruction or remodeling. So even if you're replacing something, that's not necessarily reconstruction or remodeling. If it's like for like replacement. Another one I think is important to remember, the first bullet point there. If you are, if you've got a construction project that is generally deemed complete, and then the person hires, could even be the same contract, the sponsor hires even the same contractor a good amount of time later to do additional work at that newly constructed building. It may not be part of that construction project. It may just be a separate taxable service that company is providing. And so the example here is doing landscaping or excavation. So if it happens at the before foundation goes in, that's obviously part of the construction project and would be exempt. But if that same company is hired to do grading for landscaping project, or simply for to keep water away from a building, whatever it may be, sometime after the building is complete, after the building goes up, here on the slide here, and in the rule uses the duration of a year after the construction of the building, that's going to be a taxable service. So more detail, of course, like everything else in the administrative rules. Couple slides here on the difference between repair and new construction. This again in that same rule, 219.13. So repairing is mending, restoring, maintaining, replacing, or servicing an existing structure, and so that includes broken windows, shingles on a roof. As you can see, I'll go back one slide real quick. Didn't highlight this one specifically, but that third bullet, magnitude of service, kind of highlights the roofing example. If an entire roof is being replaced, it's considered construction. If it's just part of a roof, individual shingles, etc., that would be a repair. So that again highlighted here on this slide as well. So that's in general what a repair is. New construction is is a more significant level of work, basically. Altering an existing structure, building a new structure, adding an addition, something that comes up that we see a lot is the reconstruction after damage. If somebody has, I won't go back again on the slides, but there was another example about garage doors. This was an example that came up a couple of years ago after the derecho. Somebody had a garage door that had a dent from something. It otherwise functioned. The door could go up and down, but it had a dent, and so they wanted to replace it. That is not reconstruction. That was repair, so that would have been a taxable service. If the door had blown off the railings, or otherwise stopped functioning entirely, couldn't go up and down, replacing that garage door would be reconstruction. So yeah, I won't go through all the words on the slide. Hopefully you can take a look here. Again, this is highlighted in that same rule 219.13. Spend a couple minutes talking about designated exempt entities. So these, we get a lot of questions about this because it's a complex area of the law. The statute, as you can see down there at the bottom, it's referenced in two separate places. 423.3 is the code section that deals with exemptions, and 423.4 is provision on refunds. So that for whatever reason, when this was written, more of the detail about who a designated exempt entity was put into 423.4 subsection 1. And so if you want to see, it's basically right here on this slide, but doesn't specifically list habitat, but it's pretty narrow in the statute, so that's who it is, who would qualify. But otherwise, in order to be able to make purchases of materials and labor for new construction exempt from tax, you have to be one of these entities listed in the statute. Where it gets a little bit fuzzier is, so here it's got a handful of nonprofits basically, and then rural water districts, and then instrumentalities and tax levying bodies associated with some level of government. Could be a county, could be state, and so that's all described in the statute. But the instrumentality test gets a little complicated. So, and now those questions have to be answered on a case-by-case basis. It's usually relatively fact-intensive. Sometimes it's easier than others, but if you do want to read a little bit more about that, I would strongly recommend you read through those code sections. Here I've got a link to the rule that relates to designated exempt entities. It's in chapter 19 as opposed to 219. That's not a typo, but chapter 19 was our older chapter of rules on construction. 219 is more updated, but this rule is still in chapter 19. So take a look at 19.12 if you want to see more about designated exempt entities. We also, because they are fact intensive, as I mentioned at the very beginning of this, in general, about declaratory orders, we have written several declaratory orders signed by the director in the last couple of years related to whether an entity is a designated exempt entity or not. Typically, as the analysis comes down to whether they're an instrumentality of government. And so, if that's a question that you have, I would suggest. And obviously, those DOs are only binding on the party that's named in the agreement, in the order, excuse me, and also binding on the department. But they provide a good explanation of the analysis of the law. So if a designated exempt entity is pursuing a construction, if they're entering into a construction contract, they reach out to the department and say, hey, I want to be deemed a designated exempt entity. If approved, the department gives the designated exempt entity a special exemption certificate just for that project, and then they can, the DEE can then issue those to its contractors or subcontractors so that purchases can be made without paying tax. So the suppliers, and this is true in general for all exemption certificates, not just for designated exempt entities, but if a supplier receives an exemption certificate, they should keep that on file for at least 3 years. Obviously, benefits for designated exempt entities are that when they're seeking bids for construction projects, sales tax will not apply if they know that they are a DEE, so those bids will come in lower. They do not need to obtain what we call contractor statements after the project if they get this approval beforehand, and they wouldn't need to apply for a refund of tax. As I mentioned a minute ago, a lot of the designated exempt entities, DEE, it's a little wordy, but the DEE provisions are in both the exemption and in the refund sections of the statute. And so if a DEE does not get the prior approval to get an exemption certificate for its project so that its contractors can buy things exempt from sales tax, it can request a refund after the fact. That is, as you can see here from bullet points 2 and 3, a little more intensive. They would have to get statements from each of their contractors after the project is done. So generally benefits the DEE and the contractors to have this taken care of in advance, but it is possible to get a refund after the fact as well. So, so that covers the law specifically as it pertains to materials, labor, types of projects, types of entities engaging in construction contracts. I want to shift gears a little bit and talk about how some of these things should be reported on a return, what types of permits are required, because there was a law change this year. This was part of a bill that the department proposed, and I was part of the putting this proposal together, and one of the main audiences that I thought would primarily benefit from all these changes was construction contractors, and so hopefully this makes life easier for everybody at the department and in the taxpaying community, and especially construction contractors. So as you can see here, it's a link to the bill. The department did not propose the entire contents of the bill. The legislature added lots of stuff unrelated to what we proposed after we filed it, after we got the bill filed, and we're here to administer all of it, but I'll highlight some of the things that we did propose. It did take effect. These provisions, at least, parts of the bill, obviously have different effective dates, but the stuff we'll talk about here took effect on July 1, so you may well have received some notices from the department already about these things. If you haven't, I'll show you how at the end to get signed up for our emails, but we'll dive in. So in conjunction with these law changes, we've also got changes to administrative rules that dealt with permits, return filing, and payment of tax for sales and use tax. So old chapters 12, 13, and 30 were rescinded. We adopted some new chapters, 201 and 202, to cover both sales and use tax. And so those rules went into effect on July 1. You can take a look at those through the links. We have a public hearing tomorrow on the notice on the version of these rules that's going through the public comment process. So if anybody's interested in taking a look at the rules and chiming in, it's happening tomorrow morning in Des Moines at our office at 9. If you want to join virtually, I can get you a link to that as well. I assume most of our attendees here are more interested in new and existing or excuse me, existing permit holders, probably not new permit holders, but information that relates to everyone is that businesses only need to have one permit going forward for both sales tax and use tax. If you're not new here, you would know that you needed a sales tax permit, probably a consumer's use tax permit, and potentially also a retailer's use permit if you're an out-of-state business mostly. So we had 3 permits prior to July 1. We now just have 1 permit. If the taxpayer is a retailer that has multiple locations, they still need multiple permits, or they still need a permit for each location that they're making retail sales from. And if they prefer to do for reporting or accounting or whatever, they can have separate permits to report retail sales from, but they don't have to. They're not required by law. Permit holders or taxpayers who had 1 sales tax permit and 1 use tax permit. These taxpayers I know have received notification from the department. No longer should report their taxes separately on those 2 permits. The consumer's use permit no longer useful. All tax should be reported on the sales and use tax return under the sales and use tax permit, which means we're using the old, what used to just be the sales tax permit number. The consumer's use permit number can go away. Any other taxpayers who had 3 or more permits or multiple different types of permits, if you don't fit into that 1 sales, 1 consumer's use category, we didn't change anything unless the taxpayer wanted to. The department was doing some proactive communication with those taxpayers to try to help them simplify their filings. And so, from what I've heard, that's has been going well since we started making those calls even before July 1 to get people ready. So those are changes to the types of permits that are needed. In addition, we changed the law changed to eliminate the return being due on a quarterly basis for most taxpayers. The returns are now either due annually or monthly. Previously, the annual filer group was taxpayers who only collected up to $120 in tax a year, which is almost nothing, $10 in tax a month. And so we added a 0 to that. And so anybody who collects $1,200 under $1,200 can be an annual filer. Anybody who collects $1,200 or more should be a monthly filer. And so in addition to, maybe jumping ahead here a bit, but in addition to changing the return filing frequency, we also changed payment frequencies. There are no longer deposit payments for anybody who was a quarterly return filer. Quarterly return filers in the past, prior to July 1st, may have had to make payments on either a monthly basis or semi-monthly basis or also quarterly basis based on how much tax they were collecting and remitting. Now, starting July 1, everybody's either filing and paying on an annual basis or on a monthly basis. So, I will note here for excise taxes, especially for this group, for this presentation, important to highlight construction equipment. If a permit holder has collected and remitted any of those 3 excise tax types, hotel, motel, automobile rental, construction equipment, regardless of the dollar value, if it's under $1,200, still needs to be reported and remitted on a monthly basis. Water service excise tax, if anybody here collected or remitted any of that, had a permit for that, that has not changed. That's still its own permit. And so the $1,200 does apply to that. And that calculation is based on total sales tax, use tax, and wet collected in a calendar year. So as I mentioned a second ago, in addition to combining the permits, the return there's now just one return. So every taxpayer, if they just have one, assume taxpayer has one permit, It will report all sales tax and all use tax on that one return. So that means, so every month, let's assume most taxpayers here in this group are monthly filers over the $1,200. Everything will just be reported every month. Payments will be due every month. And so you'll see in a second, we're on I'll show you some slides that are screenshots of the electronic return and also the new paper return. We're getting away from calling things differentiating between retailers' use tax and consumers' use tax. If you have more questions about that, I can explain it. But essentially, we're going to be referring to those things as taxable purchases. So that's what consumers' use tax was. Purchases that a person makes that the retailer, the seller, did not collect sales tax on. So that means the purchaser owes the tax. They're trying to pay the tax by reporting what used to be called consumers' use tax. Now we're just going to call taxable purchases. So you'll see coming up here in a few slides some screenshots of what the new return will look like. And as I mentioned a few minutes ago, so deposits still allowed, particularly for taxpayers who are annual filers who don't want to hold on to that money until January 31st of every year. They can make deposit payments. They can even just file their return early if they want and be done. But the deposits are still accepted through GovConnect Iowa, but are no longer required. So here you'll see, I'll run through these real quick, and we can try to tackle some questions. You'll see on the left above that red box, it says sales and use. So we've changed in the system. If you don't already use GovConnect Iowa, strongly recommend that you do so. It gives you, the taxpayer, a much better picture of your obligations, your permits, gives you better ways to interact with the department. One of the things I like to point out is that it also has a repository of every letter the department has ever sent you, which not accessible in the former system. So that's a big perk of GovConnect Iowa, I think. And so you can see here, everything has been shifted to sales and use. This is all fake information, of course. But nothing will say retail sales or consumers use or retailers use anymore. It's just sales and use. And so if you log in, if you haven't already, to file a monthly return for the month of July, you'll see this notification. Trying to make sure everybody's aware. I know not everybody uses GovConnect Iowa, but it's the best way to make sure you stay up to date on changes that impact tax filing obligations. So this notification pops up for everybody to check that box to advance to be able to file a return. If a taxpayer, so this jumps ahead quite a few slides, but so this taxpayer has reported all their sales tax that they owe for that month and any exemptions. Then they come, everybody who has a sales tax permit or sales and use tax permit, even if they never collect or remit use tax, we'll see this slide, we'll see this window. And if they have no use tax to report, simply click that box and then they can advance. If they do have use tax to report, let's just enter it here. So yeah, trying to make sure that everybody understands that they do have to report something. They can't just default to 0 and click through that screen. They have to, if they are saying that they owe no tax at all for use tax, they have to click that box to indicate as such. So here's the paper return. This is now published on the website. I think it went live last week, if I recall, last Tuesday. And so this is page 2, of course. Page 1 has information, has instructions and the exemption worksheet. But here's page 2. So you can see section A, sales tax, section B, use tax, and then total everything up. So I think it makes a lot more sense. It's hopefully will reduce errors for people who, and I know this happened. This was more common in construction contracting industry than many others. People would, collect or remit the wrong tax type. Say, they called something sales tax and it should have been use tax, or vice versa. Hopefully, having everything on one return and under one permit will reduce errors for the taxpayer. Certainly not trying to make life more difficult for taxpayers over there or their accountants. And so hopefully this helps. And you can see there are lines 7 and 8 replacing consumers use tax and retailers use tax. I will note one question that I've gotten is if somebody's making sales subject to use tax, formerly known as retailers use tax, how do they report those exemptions? They can just back those exemptions, those exempt sales from retailers use tax out before they report it on that line. So should not be included on the exemptions line on line 4 for sales tax, because it's not sales tax, it's use tax. So here's the new return. Paper return should only be filed by annual filers or anybody who cannot use the electronic filing. The monthly return, these returns through GovConnect Iowa, anybody who has to file a monthly return has to do it by law, has to file and pay their return electronically. So a couple links here to wrap things up. In addition to Chapter 219, which can be a little tough to read, I appreciate that. We do have an easier to read construction contractors guide out there. I'm largely responsible for maintaining that, making updates. And so we try to stay on top of that whenever something changes, or if we get questions, someone points out that something's not clear, we do update it on a relatively frequent basis, a couple times a year at least. And so if you have not seen that before, I would strongly recommend you take a look at the guide. Of course, it's not binding because it's not the law. Only the administrative rules and the statute are binding law. But the guide is, I think, a good place to start if you do have questions. For anything I covered in the latter portion of this about permits, filings, returns, payments, etc., take a look at our guidance if you haven't already seen it. Link there as well in the second bullet point. If you have additional questions, of course, feel free to reach out to Taxpayer Services. We also have, I don't have the link here, we also have a tax guidance request form, which I think you can find pretty easily through our from our homepage. And if you can't find it, just on our homepage, tax.iowa.gov, just search for guidance request, and I'm sure it'll come up. So the last thing I'll plug is our email service. If you are not already subscribed, please do so. You can, you'll see so this is a screenshot from the bottom of our homepage. You'll see a link that says subscribe to updates. And so once you click through that, you'll have a long list of options of things you want to get emails about, withholding, tax credits, sales use tax, etc. So please make sure you get signed up for those if you're not already. There we go. Yeah. So that wraps the information I had. Do we have any questions that we would like to address now?
Well, great job, Tim. Thank you so much for that. We do have about 5 minutes left in the presentation window for today. Sophie will post a link to those guides that were on your slides in the chat. So if you need to get those, you'll be able to grab those. This has been recorded. We've got the questions in there. Hopefully for some of you, Terry has been answering them in the background. So Tim, if you want to take a minute and sort of briefly look through on those Q&As. and see if there's anything else that makes sense to get answered. We can do that in our last couple minutes left. We do run this series all throughout the summer. So be sure to check out other ones that we've got going on upcoming next in September. We're going to have the Iowa tax law legislative update, and that might be Tim again. So Tim might get to come back and do that one, or it might be somebody else. We'll see.
It's gonna be somebody else.
Somebody else. Tim doesn't want to be here. That's okay. No, we're good. We appreciate you being here for this. But yeah, September 14th is going to be the Iowa tax law legislative update. So Tim, hopefully you've had a chance to maybe briefly look at the Q&A. Any in there that you want to that we can generally answer in our last couple of minutes?
Well, some of these are fact specific. Let's see. I'm down at the bottom. Heard through third party that we're adjusting. Yes, people who are under the new annual filing threshold, but we're notified that they should file monthly. We should be sending out. I don't want to say will. We should be sending out notifications to those taxpayers impacted that were moved to monthly but should be annual within a week. I helped review a letter. The letter is gonna be specific to taxpayers, each account that taxpayer has based on when they last filed for that account. So we're gonna try to be as specific as possible for each taxpayer. So that should be going into effect very soon, hopefully within a week. Do we have data center exemptions? Yes. There are 3 separate ones. They're in section 423.3. Toward the end, I think they're in the 90s. We have quite a few exemptions if you're not familiar with Iowa sales tax law. But I forget that it's like 92, 93, and 95, somewhere around there in the 90s in 423.3.
There's one in here, maybe a little bit about the language around use tax. Are the words use tax and goods consumed interchangeable, or is there a bit of a distinction in those terms?
Yeah, good question. No, goods consumed are items that were purchased where sales tax should have been collected. Say somebody purchases something from a supplier and says, I plan to resell this, and so they claim a sale for resale exemption, but then they end up using it on their own, incorporating into their own facility or whatever the case may be. And so that's the type of purchase that should be where sales tax should have been collected. That is a goods consumed. Those are goods consumed. So that's a bit different from use tax, where if you are buying something and then you claim an exemption for whatever reason, or the retailer, the supplier doesn't collect sales tax, then but not because of anything that you did or because you asserted that you were going to resell it, then that would be if a purchaser makes a purchase and the retailer or supplier fails to collect sales tax, the purchaser is only liable for use tax. So unless in a situation where the purchaser indicates that they are exempt or shouldn't have to pay sales tax, but then they later do something that would trigger sales tax to have occurred, such as reversing a sale for resale claim, then the purchaser should remit use tax. Hopefully that makes sense. It's a bit tricky, but they're not exactly the same.
Right. No, I think that does make sense, and maybe can play a little bit into probably the last question we can take today. Let's say someone does pay sales tax, whether it be for their cost of goods sold and because it's for resale, and they weren't supposed to. What is the process that they can do to get credit for that sales tax that they paid when they weren't supposed to?
If somebody pays sales tax that they realize they should not have, we would strongly recommend somebody use the 843 form, as I think we're reading the same questionnaire, Patrick.
Yep.
Yep. So they should, that person should file an 843 and to claim that refund. I'm sure there are taxpayers out there and tax practitioners who would simply do the accounting on their own and claim credit, but technically that's not the most accurate way to do that. Filing an 843 refund claim form would be the best approach.
All right. Well, once again, Tim, Terry, thank you again for being here. Terry for being in the background and answering a bunch of questions while Tim was presenting. And Tim, thank you again for the great presentation and information on sales and use tax for construction contractors. It's definitely can be a bit of a complicated topic, very fact specific. So if there are specific other questions that you do have around your particular instance, please do contact the department at idr@iowa.gov to make sure that you can get answers to your specific questions. This webinar has been recorded, again, for general educational purposes. The link to the slides and the recording will be up and available on Iowa SourceLink, iasourcelink.com later this week. So on behalf of myself and John Papajohn Entrepreneur Center at the University of Northern Iowa, thank you to the Department of Revenue for doing this with us. If you are interested, please come back and join us on September 14th. That is going to be our Iowa tax law legislative update. You can register for that at the link in the chat. Otherwise, until next time, Tim, Terry, thanks again, and hopefully everyone has a great rest of their August.
Sounds good. Thanks, everybody. Patrick. Thanks, everybody.
Thank you.